look, I think just taking a step back here, obviously, rates and oil are, kind of doing what I guess you'd expect them to do in this sort of stagflationary regime. I wanted to kind of revisit an early look that I wrote last year. And, two of the points of the early look, one was, when you look back through history since the 1950s, there have been 10 recessions since 1954. All 10 of them have been preceded by a significant rise in short-term rates. So, you've obviously got that going on. You've got the 2-year making, fresh highs, up 29 basis points just this month alone, sitting now at 513. You've got the 10-year just blasting off, sitting at 463. That was at 409, at the end of August. So that's moved up just sort of a mild 64 basis points in 4 weeks. And then the other thing I looked at was oil. And, we've got more history even on oil, where if you go all the way back to the mid 1940s, 1946, so then you've had 12 recessions since then. And of those 12, 8 have been preceded by significant oil price shocks. And then 3 more have been preceded by more moderate oil price shocks. So, call it 11 out of 12 have, been, you could argue, is a correlation, is a causation. I mean, I think it's pretty reasonable to assume the latter. When energy prices spike, or when, the cost of money spikes, these things obviously don't happen in a vacuum. So the point is that, again, here we sit, in late September 2023, this sort of dynamic has been festering for a while, with rates having risen obviously quite dramatically, not just in the last 4 weeks, but, over the last year and a half, 2 years. And obviously energy is sort of, in the reascendancy, if you will. Oil prices have gone up since, roughly 3 months ago, from 70 to 93, 94. So we're up roughly 35% in, call it 3 months. So, all these things are, they're pretty textbook through the lens of history. So, obviously today we'll host our Q4 macro themes call, as you talked about, and we'll go through that, but obviously a lot more. We'll unveil some new things as well. But I just think, it's so easy to sort of, get lost, in the short termism of a lot of things, and lose, the proper context for sort of where we are in the bigger cycle.
Okay, if all you believe is in presidential cycles in a chart, Steiner, you would not have the conditional factoring. Okay, what happens in a presidential cycle going into A, recession, B, oil that perpetuates a recession, C, interest rates breaking out that perpetuates a recession. With all those three, and I'm just using 3, we could add China slowing, Europe being in a recession, USA being in an industrial recession already. We could add, the list goes on and on and on. Hedgeye Nation is responsible for this at this point, is what I've determined since July. And that's why I said it's phase 2 of Hedgeye risk management. 15 years in, we've entered phase 2. We're absolutely right on that. And it's really time to take a look back at all these things, from oil to rates to cycles, and consider all the conditional factoring before you make your next move.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.